Hello everyone, this is Phil Yaeger of Yaeger CPA Review, and we have asked students on our Facebook page, what video topics would you like me to go over? Now, one of them is the one I'm going to do today, which is basically the issuance of bonds, all right, using the effective interest method, and also showing how you use the different present value tables to come up with the price of the bonds you're going to issue, and also any journal entries when you actually accrue the interest, pay any interest, all right, and amortize, discount, or premium. Now, I'm going to go by the blueprint that is the AICPA's task. And under bonds payable, the blueprint says, calculate the interest expense attributable to notes and bonds reported in the financial statements, which include discounts, premiums, or debt issue costs. Calculate the carrying amount of notes and bonds payable and prepare journal entries. Now, first of all, some terminology you should know here. All right, when they throw out this rate, it's called the stated rate or the coupon rate. The stated rate or the coupon rate is the actual rate that the corporation who is actually borrowing your money, issuing the bonds to you, all right, is going to calculate their interest on. So if they have a stated rate or a coupon rate, all right, and by the way, let's assume it's 10% and they pay interest semi-annually. They're going to pay 5% interest every 6 months. So determine the actual payment you'll get every 6 months. You'll take the stated rate for 6 months, 5%, times the face amount of the bonds. Not the carrying value, the face amount of the bonds. All right? Now, another rate they use is called the yield rate. All right? And the yield rate is really defined, by the way, it's also called the market rate, but the yield rate is really the rate that similar bonds are paying. So, the bottom line is this. If your corporation, if their stated rate is less than the yield rate, you're paying a rate lower than the market is paying, all right, you're going to have to sell your bonds at a what? Discount. But if the stated rate, the rate you're paying on the bonds, is greater than the yield rate, which means the rate that other bonds are paying, then you can sell the bonds at a premium. All right, so there's some of the terminology. Now, let's start off with the next thing. All right, how does one calculate the price of bonds that they're issuing? Now, we're talking here about the standpoint of the liability, the bonds payable. All right, first of all, remember this. When you sell bonds, you're selling two things. The promise to pay the face amount of the bonds when they mature, and also the promise to pay interest payments in the future. But remember, we're actually selling the bonds today. So, this is what you have to do to get the actual issuance of the bonds. All right, first of all, you take the face amount of the bonds. And to figure out, by the way, this is in the future what this amount is, but to figure out what it's worth today, you're going to multiply this by the present value of $1 table, all right, and what rate you're going to use? Well, you're always going to use the yield rate, and also you're going to use the number of periods, all right, that you're going to pay interest on these bonds. So if these are 10-year bonds, all right, and the yield rate is 10%, then you're going to go to get the factor to multiply the face amount by, you go to the present value of $1 table. All right, now, if they pay interest semi-annually, you're going to have 20 periods, and each period, the yield is going to be what? 5%. So get the factor for 20 periods at 5%, multiply it by the face amount of the bonds, and that equals a present value of the face amount. Also, the issuance of the bonds contains another factor, all right? It contains what? You're selling today, the present value of the face amount of the bonds, but you're also selling the present value of the interest payments. So what you're going to do is this, all right? You're going to take the interest payment, that's paid every interest period. So let's assume it's a 6% stated rate. And the market rate is 10%. And interest is paid semi-annually. Now, let's assume the interest is paid at the end of every year. Well, when you go to the present value of an annuity table, all right, because you're going to have to take the present value of the payment. Now, let's assume we have this situation. All right, let's assume we have a $100,000 bond. All right, and we pay interest 6% a year semi-annually. So therefore, every interest payment period, you're going to pay what? 3% of $100,000, and I believe that's $3,000. Now, you're going to multiply this by the factor for the present value of an annuity. Now, the fact that the first interest payment and every interest payment thereafter is made at the end of the period, you're going to go to the present value of an ordinary annuity table. Now, what are you going to have to do? Well, you'll take the $3,000 and you have to look for the factor. Now, what factor are you going to look for? You're going to look for the factor for the market rate, 10%, but remember, they pay interest semi-annually. And what did I say it was? Let's assume it's a 10-year bond. I don't know if I mentioned that. All right, so what they're going to do is this. All right, you'll take the market rate of 5%, all right, and if it's a 10-year bond, all right, that 5% yield will be over what? How many periods? 20 periods, because 10-year bonds, there's going to be 20 interest payments. All right, so you can take the present value of an ordinary annuity at always the yield or market rate, which is 5% each period, and because you pay interest semi-annually for 10 years, all right, you'll take 20 periods. All right, now, this times this factor will equal an amount, and if you take the present value of a $1, all right, of the 100,000, that will equal the present value. The total of these two amounts will equal the issue price of the bonds. So, what do? Let's assume the bonds are 100,000, but we come up with, after we add these two together, an issue price of $95,000. All right, now, what entry will be made on the books if we're selling them? Well, all right, we'll debit cash for $95,000. All right, we'll credit bonds payable, always issued at the what? Face amount. Credit bonds payable, $100,000. And because we need a debit to make this entry balance, the debit will be what? Unamortized bond discount. Now, if we sell the bonds for more than, all right, the face value, let's assume it comes out to, we add these two amounts together, and this comes out to, say, $105,000. All right, we're going to debit cash, $105,000, credit bonds payable, $100,000, and we're going to credit what? Unamortized bond premium. Now remember, the accounts, unamortized bond discount, unamortized bond premium, are contra accounts to the bonds payable account. All right, please remember that. Now, then what you're going to have to do is, all right, you're going to have to set up an amortization table. All right, and the amortization table is made up of 4 columns. All right, now what are they? The first column is the interest payment. The second column is the interest expense. The third column is this, the difference between the interest payment and the interest expense. The difference between those two columns is the discount amortization or the bond amortization. Now, if you issue the bonds at a discount, the amount of the amortization is going to increase the carrying value. But if you issue the bonds at a premium, then, all right, the amortization of the premium will do what? It'll reduce the carrying value. So when you get done, all right, and you amortize the discount for the full period of the bonds, all right, it's going to equal what? At the end of the full amortization period, it's going to equal the face amount of the bonds. All right, so let's get the columns here. First column, interest expense. All right, now how do you do that? Well, you take your stated rate, And by the way, if you pay it semi-annually, you take the stated rate for half a year, all right, and you multiply that by the face amount of the bonds. So the interest payment is the what? The actual stated rate, all right, and remember, you pay it semi-annually, all right, the stated rate is going to be half of the annual rate, all right, and then you're going to have the interest expense column. Now, the interest expense column is calculated by taking the what? The yield rate, and if you pay interest semi-annually, it'll be the yield rate for half a year. Now remember, the rates are always stated, whether it's the stated rate or the yield rate, they're always stated as annual rates. So if you pay interest semi-annually and the yield rate is 10%, you're going to multiply that by the yield rate of a half a year, which would be 5%, and that 5% is multiplied by the carrying value of the bonds. All right, now the difference between the interest expense and the interest payment is the discount or premium amortization. Remember that. All right, so be familiar with that. Now, you have to know this. When you're calculating the interest payment, it's always what rate? The stated rate, for the, all right, whether it's semi-annually or annually, depending upon when you make the interest payment. So it's the stated rate times the what? Face amount of the bonds. All right, the interest expense is always what? The yield rate. Now remember, if it's for semi-annually, you're going to take half of the yield rate, and what are you going to multiply that by? The carrying value of the bonds. And then the difference between the interest payment and the interest expense is the amortization of the discount or premium. Now, if the bonds were issued at a discount, you're going to have amortization of discount, and you're going to add that amortization of discount to the carrying value. All right? And these are the entries you'll make. All right? Well, first of all, when you issue the bonds, I told you, you'll debit cash, all right? You'll credit bonds payable, always at the face amount, and, all right, what happens? If the yield rate and the stated rate are not the same, you're going to have a bond discount or bond premium, all right? So if you actually have this, if your stated rate is less than the yield rate, you're going to have an unamortized bond discount. So your journal entry when you issue the bonds will be what? Debit cash, debit unamortized bond discount, credit bonds payable. Now, when you make the first payment, all right, so if the first payment is made July 1st, all right, what are you going to do? All right, the first payment is made July 1st. All right, so you go to your first amortization period, all right, and you see that the interest expense is $50,303. You see your interest payment is $50,000. All right, so what you're going to do is you're going to debit interest expense, all right, credit the amortization of the discounted premium, all right, and then you're going to credit cash. And remember, you're crediting cash for the actual payment you make for that semi-annual period. Now, at the end of the year, December 31st, don't forget, you must accrue interest that you will owe, all right, during the next year. So you have to do an accrual entry because you're on accrual accounting. All right, so at December 31st, don't forget, look at the interest that is going to be paid during the second period or this next year, and you're going to accrue that interest, which means you'll debit interest expense, credit interest payable. Okay? All right, so that's the thing. And by the way, you do that also. All right, it's the same amortization table for the discount as well as the premium. And don't forget this, all right? The way bonds are showed on the balance sheet is this, all right? You're going to show bonds payable less the unamortized discount or bonds payable plus the premium. And obviously, the amount of bonds that are due within the next 12 months following whatever year end is, all right? That's the amount of the bonds payable which will be current. The balance of the bond payable would be what? Non-current. Okay? All right? So, all right, let's talk about debt issuance costs. All right, debt issuance costs, which are known as bond issue costs, are to be accounted for as a direct deduction from the carrying value of the bonds in a manner similar to bond discounts. All right, and amortization of bond issue costs are reported as interest expense. The amortization is done on a straight line basis over the life of the bonds. And remember, all right, previously it used to be bond issue costs was shown on the balance sheet as a deferred asset, deferred charge, and then they were amortized over the life of the bond. But remember now, all right, unamortized bond issue costs are now a contra account to the bonds payable. Please remember that. They are now contra accounts to the bonds payable. All right, now let's talk about one other area here I want to go over. All right, what happens if you sell bonds with detachable warrants? All right, what happens if you sell bonds with detachable warrants? Well, a warrant is really a document where the bondholder can buy stock in that company. The company issued the bonds. All right, now, if the bonds have detachable warrants, when you record the sale of the bonds and the warrants, all right, you'll debit cash. But you're going to have to take that cash and allocate it to the bonds payable and also to the detachable warrants. Now, the amount you allocate to detachable warrants is credited to paid in capital. Detachable warrants, paid in capital, all right, warrants. All right, now, how do you allocate it? Well, all right, you're going to take the proceeds, all right, from the sale of the bonds with detachable warrants, and to determine the amount you allocate to the warrants, all right, you're going to take the proceeds and you're going to multiply that by the fair market value of the warrants over the fair market value of a warrant plus the fair market value of the bonds. Now, if you know both the fair value of the warrants and the fair value of the bonds, when you issue the bonds, all right, you have to allocate the proceeds to each of these. So to get the warrants, you take the fair market value of the warrants divided by the fair market value of the warrants plus fair market value times the proceeds. So whatever you get here becomes what? Let's assume the total proceeds were, all right, $95,000. That's what you sold it for. And you calculate this, and you find out the amount of proceeds that goes to the warrants, all right, just making this up, is $8,000. All right, now, let's assume the bonds issued are $100,000 bonds. All right, now let's plug in the entries here. All right, we're going to credit paid in capital warrants because we figured out that when we did the proceeds times this formula, it gave us the amount of the proceeds going to the warrants of $8,000. Now, we're going to credit bonds payable, all right, for the face amount of the bonds, which would be what? $100,000. All right. And now what do we do? All right. Well, we're going to debit cash. All right. Total proceeds are $95,000. Now, whatever we need to make this balance goes to either bond discount or bond premium. All right. Well, we have credits of 100 plus 8. That's 108,000. We have debits here of 95. So there's going to be a bond discount. That's going to be our plug here. All right. And it'll be the 108 minus, okay, the 95,000. And that will be $13,000. That's the amount that goes to bond discount. Now, you only do this amortization when you know the fair market value of the warrants and the bonds. What happens if you just know the fair market value of the warrants? Well, if you know the fair market value of the warrants, this is what you do. You don't know the fair market value of the bonds. All right? So, you'll credit paid in capital warrants for the fair market value of the warrants. All right? And then the balance of the proceeds. Now, the balance of the proceeds would be what? The 95,000 minus the 8,000. So now the balance is what? $87,000. All right? And you're going to have to take that 87,000 and allocate it to the what? Bonds. All right? Now, what do? We'll still credit bonds payable. All right. We'll debit paid in capital warrants, 100,000. All right. Now, the proceeds are still $95,000. All right, we'll credit bonds payable for what? $100,000. And once again, because it worked out this way, all right, the bond discount will be $13,000. So you only do the proration when you know what? All right, the fair value of both. If you only know the fair value of the warrants, credit paid in capital stock warrants for the fair market value of the warrants, all right, and the balance of the proceeds will be allocated to the bonds. So you always know the bonds payable, your credit bonds payable. And then, all right, if you know the proceeds, you're going to take the bonds payable account, which you credited, and the debit or credit will be a plug to bond premium or bond discount. Okay? All right, well, that really covers that area. I hope, it's not that a difficult area. And what I would do is I would get some multiple choice. I would practice this and make sure you know how to do this. Could it be a simulation? Of course it could, all right? Simulations, they could ask you the different journal entries, all right? It could also be multiple choice. So just know the theory, know how to do the amortization table, know how to make the journal entries, and you know what? You shouldn't have any trouble with this, all right? By the way, have any questions? You can always get a hold of Phil Yaeger at 301-874-4900. 301-874-4900. That's in Maryland, and my extension is 5. Okay, everyone? Take care, and good luck with bonds payable.